Hey traders, Dave here from The5ers Futures. Today we're going to break down a very simple but sometimes a little misunderstood tool in the trading world, the moving average and the exponential moving average, and the difference that exists between the two. Now, by the end of this video, you'll know exactly how to use each one. So let's dive right into the charts and figure out what these tools are for. So let's start with the basics. A moving average smooths out price so you can understand the trend without all the noise. It's not predicting the future, it's showing you the average of past prices so you can understand the market's direction and momentum. Now, on this chart here, I have two moving averages. In green, we have the simple moving average, also called EMA. Basically, it takes the last X amount of candles you have, adds them up, and divides them. So here I have a 20-period moving average in green. So it's taking the average of the last 20 candles and, like it just said, adding them up and dividing them and giving you that smooth line. And then we have the exponential moving average. Now, it uses the same idea as the simple moving average, but it gives more weight to recent candles. That means that it can react faster to price changes. So why does this matter? Well, the EMA is more sensitive, right? It picks up momentum shifts earlier and it hugs price more closely. So let's zoom in and we're going to see the difference between the two. So now we're looking at a 5-minute chart. We're looking at the E-mini NASDAQ futures, and we're looking at the simple moving average in green and the exponential moving average in purple. So as you can see here, as price is moving downwards, the green, the 20-period simple moving average, is continuously smooth, while the EMA, the exponential moving average, which I've put at a 9-period, so it's checking the price of the last 9 candles, is reacting much faster. So, for example, if you want to get a direction of the trend, you could look at this and you can see, okay, my trend is flattening out and maybe turning to the downside, while my exponential moving average is really reacting to price. So a rule you could have and how you could enter a day trade is once the price closes above or below the 9 EMA, I enter the trade, right? And then once the price closes or above or below the simple moving average, I exit my trade. So for example, here, as the market opens and price kind of shifts, here we could say, well, price just closed way above the exponential moving average, so I could enter my trade. And then I would hold the trade all the way until it closes under the 20-period moving average, because my trend is going upwards, and I would exit my trade. So that would allow me to enter somewhere around here, hold through all these pullbacks because we never closed under the trend, and exit nearly at the top right here. So a quick, easy setup that you could possibly use in your trade. So basically, you're going to use the MA, or a simple moving average, when you want a smoother trend line. You're trading maybe a swing structure, or you're looking at things longer term. You want to avoid false signals. And you're going to use the EMA when you're kind of trading momentum. You're scalping, you're day trading, the market's moving quickly, and you're also going to adjust the settings so it can add weight to the more recent candles. So that is one simple way you could use these two moving averages. So I hope you like this breakdown. I hope it was simple and straightforward enough so that now you can apply it to your trading. Remember to follow us, subscribe if you haven't. We're here to trade futures confidently together. And as usual, I will see you in the markets.